value for equities relates to typically discounting the future cash flows that people expect to receive from equities, either in terms of the free cash flow within the organization or dividends that are expected to come out. And so they make an estimate of what the expected returns will be, and they ask themselves if it's worth the risk. So that broad concept fully transfers into the credit environment. We think of it differently, of course. It's a different asset class. But when you look at a yield to maturity on something like a NAB, a hybrid, to give you an example, well, you can actually break it down to several different components. You can ask yourself first, if I invested in the Australian government, a AAA rated security with negligible default risk, what would that get as a yield to maturity for the same kind of same time frame, if you like? What is the risk on top of that NAB will default on this particular bond? That's the default component. What is the liquidity premium over and above that? So the market demands a higher return because you can't get in and out of these securities as well as you can with a government bond. And then there's the residual. That stuff is like complex features, let's call it. So it's like term documentation that you'll find on page 73 of a 200-page document, and it's to do with what will happen if the capital levels drop to a particular level or a tax thing changes or things like that. They add a degree of aversion for people to go and get set in those assets. So when you break it down that way, you compare the yield to maturity that you might get from this security against the sum of the parts. And if that yield to maturity is higher than the sum of the parts, for us, that represents an interesting opportunity. It looks cheap, but there are obviously other stages before we just add that into the portfolio. And another opportunity is within what we call mezzanine and junior RMBS securities. That's a very technical term. What that is when it's just a portfolio of mortgages. So we can go to Commonwealth Bank, I can get a mortgage, and Commonwealth Bank might own my mortgage, or in fact, Commonwealth Bank can sell my mortgage to other people along with 1,000 other mortgages. So we actually own packages of those types of securities, and they have particular features. And in the case of the ones I've just referred to, the junior and the mezzanine components of them, they didn't benefit very much at all from the monetary operations that came through from March of last year. So that's a natural place for us to go into, and it feels pretty good to us because there's a strong commitment to maintaining or achieving full employment from the federal government as well as the RBA. In order for there to be distress in the mortgage market, you need to have unemployment coming out where people simply cannot pay their mortgages. That's the environment that triggers it off. We've got the full force of all the institutions in the Australian market to make sure that doesn't happen. On top of that, in the event that somebody can't pay their mortgage, you only take a loss if the house value has declined below the value of the mortgage. And house prices have been very strong since these mortgages were issued. So if there's ever a time you're wanting to buy these securities, now would be a great one. And they, again, didn't benefit very much from the monetary operations, and therefore we think won't suffer too much as it goes out the other side. So these are still offering good opportunities despite the fact that credit conditions may be a little tighter now, or the credit prices, if you like, are a little tighter now than they've been for a few years.